first topic which we are going to go through, we are starting through, is the balance sheet statement of financial position. And within that, we are going to talk about GAAP. So, and before we get into GAAP per se, that okay, who uses GAAP, who develops GAAP, who enforces GAAP, is something probably we'd like to start with. When we say who follows GAAP, public held companies follows GAAP. There are privately held companies also follows GAAP. Now, who actually authorizes GAAP? It is SEC who authorizes GAAPs or who endorses GAAP. That okay, GAAP needs to be followed. What is the role of SEC into this? SEC, like SEBI for India, SEC in US, they're more, the existence is to make sure that they check for completeness. They don't want to make sure that info is correct, incorrect. It is for the auditors to give an opinion on the data. But what SEC does is, or what they want to make sure is, that as an investor, you get material, relevant, reliable data as an informed investor, right? They want to make sure that when you look at the balance sheet, you can look at the assets, you can look at the liabilities, you can look at the equity. If you would like to know what is the capital structure, how much is debt, how much is equity, what are your assets, what is the capacity of your assets, performance. If I have to see income statement, like over a period of time, can those assets what you have generate sale? Can that sale generate profit? Ultimately, can you generate cash flows? Can you give us the required return? Give us the final value. Finally, can you give us the value? So many things which SEC comes under SEC purview per se, right? And who are they controlling? They're controlling public held companies, because they need to make sure that they submit their financial statements to SEC. They follow a general purpose framework. Now, generally, there are two general purpose framework: generally accepted accounting principle GAAP or international financial reporting standard IFRS. Now, when we're talking about CPA, when we are talking about GAAP. So one thing, while we go through this entire chapter or lecture, we need to think we are domestic to US. We will be thinking, when I say domestic currency, we are talking about USD. When we are talking about GAAP, particularly as a reporting entity, we are talking about an US entity. So that is how, because normally we think on, when I say domestic, we think about India. Oh, yes, like you have examples which you can correlate to, but our focus is US. You're studying CPA, probably that is how you need to focus on that. Now, coming to that, not only the public company follow general purpose framework, the non-public companies may also choose to follow general purpose framework. Now, they have a choice. They can follow there's something called special purpose framework, there is general purpose framework. Why would non-public company follow a general purpose framework? Now, that is a possibility that, okay, they're such big size companies, in future they would like to get listed, so they start following GAAP from before. Or they are having some debt or loan arrangements with banks or financial institutions who require them to follow general purpose framework. Or in future, they have plans to get merged, acquired, M&A plans, which is why they are focusing more on general purpose framework, so that they're consistent with other set of companies who they have some plans in future. Now, special purpose framework, definitely we are going to talk as a subject separately, as a topic separately. Coming back to this topic where we started, GAAP. Now, GAAP is developed by accounting body, Financial Accountants Standard Board, FASB, right? And who authorizes FASB to prepare these GAAP? SEC, Security and Exchange Commission, is the one who authorizes to establish the GAAP. Now, there are two laws, SEC laws, which just remember these, and all wherever I would correlate that, okay, these are the kind of questions, these are the topics which can come as a question, because it could be objective question or it could be in a simulation. I'll try to call that out, so that because these are small points where we think, should we remember this? Do we need to remember the code? Do we need to remember the act? Sometimes yes, sometimes not. So wherever it is relevant, probably I'll try to call out that for your reference. particularly as I was saying, 1933 Act for SEC. Now that was when the first time IPO to raise the capital, and 1934 Act was for subsequent trading and reporting requirements. SEC is the one who enforces accounting and auditing standards. SEC oversee Public Company Oversight Board, right? They protect investor. They want to make sure that they are regulating the market. It is maintained fairly, orderly. Now, FASB is like accounting standard codification, ASC, right? This is the accounting standards are codified. When you say codified, they are a single source of authoritative GAAP for non-government entities. For non-government entities. For government entities, it is not FASB, it is GASB, right? We have separate law for government set of accounting. Now, government law, right now, previously it was in FAR only. Now it is moved to the bar exam, and we can take it further when it comes to that. GAAP side of things, is it cash basis? It is accrual basis. It seems like it is actually accrual basis of accounting, right? It is not cash basis. We do not record revenue when cash is received. We do not record expenses because a bill is paid. We recognize revenue when either it is earned, collected, or collectible in the period incurred as per matching principle. So we may expense it over the period, or we may expense it immediately, depending it is a period cost, depending it is a cost whose benefit we are going to take in future. In US GAAP, SG&A, selling general and administrative expenses, and research and development expense are considered as period cost. Now that can be this information, like yes, particularly relates to US GAAP. R&D can be used as may not be considered as period cost in other standard, but for US GAAP purposes, let's focus and let's try to remember it could be that way. Now, expense. How do you recognize the expense, right? There are three bases probably you're looking at. There could how you need to recognize. There could be a cause and effect. When you say cause and effect, there is a direct matching, right? Some event happens, and due to that there is an effect. And the best example is inventory. It is an asset when it is in our inventory, but when it is sold, it becomes as cost of goods sold when the sale is recognized. So that is how you identify it. But when it comes to systematic and rational allocation, now this covers what kind of cost that produces revenue over long period of time. That is our non-current assets, our PP&E. If it is tangible assets, you will depreciate over useful life. If it is intangible assets, you will amortize it. If it is natural resource, you're going to deplete it. And then third category we have to talk about is immediate recognition. Period cost. Immediately you expense it, right? I told two things, like two examples, particularly selling general and administrative expenses, most of R&D, right? And then there are some interest expenses. Most of the interest expenses rather would be covered under immediate recognition. There are some exceptions, like construction of factory, borrowing, like when you do it, and in those kind of situations, interest can be capitalized. So we'll talk about that when it comes to that, right? And if I'm now taking this further, what is the purpose of our balance sheet? What do you do with balance sheet, right? One of the bigger purpose of the balance sheet is to assess financial risk, right? Then there are two types of financial risk we're talking about here: long-term risk, short-term risk. What is long-term risk? We look at the solvency, we look at the capital structure, we look at what is the debt, what is the equity, what is the debt-equity ratio, how the capital structure is maintained. And when it comes to short-term, we are looking at going concern, looks at liquidity. So if your asset composition is sufficient, it is more factories, what we'll think, okay, you're having more factories, you're having more assets, you're having more capacity to generate revenue. So those are the things which comes in your mind when you're looking into balance sheet. Another point which we need to probably, which we know, in fact, book value of equity is not equal to fair value of equity, right? We don't say that asset and liabilities are measured in fair value. It is measured in variety of ways. One of could be fair value, but that's a rare exception. On exceptional basis, only you would be measuring on fair value. Most of the assets, when it comes, probably you will be measuring at historical cost, right? Because US GAAP focuses more on reliability over relevance. And when you say reliability, more at historical cost. Now, when you say about liabilities, how would you say that liabilities are measured at historical cost? Liabilities, when you're measuring at present value of future cash flow, taking the discount rate of the current period, it will give you current fair market value. But if you take at the time when debt was issued, it will give you the historical cost. And it's not that there are certain assets which you report which are marked to market value as well. So balance sheet is as of a specific date. It is cumulative. When you talk about its economic resources, we're talking about probable future economic assets. At the same time, there are liabilities. And when you say liability and equity, the difference in liability and equity is, one big thing is that, okay, liability has to be paid. There is a maturity date. There is a probable future sacrifice. It is not optional. You don't have an option that you can pay or you cannot pay, which you have in equity from owner contribution or prior year earning, whether it is contributed capital, whether it is earning capital, right? So that option you have over there. Now, if you look at the three basic elements of financial statement: assets, economic resources, probable future benefits, controlled by an entity, derived from past events. And when you talk about liability and equity, basically your capital structure, that is what it comprises, right? Liability and equity. Now liability have the first claim on assets, right? Assets equal to liability plus equity, and assets minus liability equal to equity. So equity holders have residual interest. So in the event there's a liquidation, equity holders will get the residual interest. Within equity, then there can be preferred or common, and within preferred, probably if you talk about, there is dividend, which they will have a claim, they'll get it before the common stockholders. And if a time comes, if a liquidation happens, probably again preferred will get a better opportunity, or before they will get a better chance than that. Assets, how do you present those assets? Like, assets are presented in order of decreasing liquidity. So first, most liquid assets are shown. First, you will go with cash and cash equivalent. Then you will go with account receivable, inventory, and so on and so forth. While liabilities are presented in the order of maturity. Current liabilities are presented first, right? And then comes owner's equity. It is shown in order of permanence. First is common stock, preferred stock, additional paid in capital, retained earnings. Then comes accumulated OCI. And then last, if there is any treasury stock, right? That is how, but again, it will be, the signage would be different, it would be debit. But that is how probably your balance sheet structure would look like. One question which probably you need to understand is current assets. The difference between current assets and current liabilities will be consumed or converted into cash within 1 year or the operating cycle, whichever is longer. Likewise, current liabilities settled within 1 year or operating cycle, whichever is longer. Now, please understand, there you can see an objective question over there, which we may say, okay, current assets converted into cash, whichever is longer, whichever is shorter. For current liabilities also longer, shorter. You have to remember it is always longer. Whichever period is longer, you have to consider that. And what is non-current assets or non-current liabilities? It is something which is not current assets, and current liabilities is non-current assets. That is how probably you need to think about it.